Hello everyone, my name is Robert. I come from Uganda, East Africa. I am a master's student at China University of Geosciences, Department of Economics and Management. So friends, I come to discuss what is termed as the Pigouvian tax. What is about the Pigouvian tax? Alright? So we are saying that a tax that is imposed on an economic activity that generates a negative externality. As we are all aware that an externality is uncompensated impact on one person's action on the well-being of a bystander, and in this case a bystander is someone who is available, who is around on the scene of an event but does not practically take part of the event, is what we call a bystander. So in this case, any activity that creates a negative impact to the society or to the people around that where the activity is taking place is a negative externality. And for this to be minimized, to be controlled, it needs the involvement of the government to come and try to manage or control these kind of activities that are taking place. So that is when the so-called Pigouvian tax comes in. A tax that is imposed on an economic activity that generates a negative externality on a bystander. Okay, so when we talk about Pigouvian tax, what can be some of the examples of Pigouvian tax? Okay, so challenges like environmental pollution, of course it is harmful to the environment, so government can come in to try to control this kind of plan of people who are doing pollution. Harmful substances like tobacco, alcohol. So we are all aware that when someone smokes in public, the other people are infected, even more than the person who is smoking. Okay, so when you talk about congestion and so on and so forth, so these are some of the examples of what we can call maybe the negative externalities to the society or to the people around. We can call them the bystanders. All right. So now, in details, what is the Pigouvian tax? Take a look at this illustration here. We are having this as the supply curve. The S equals PMC1. S is the supply, PMC is the private marginal cost. All right. So now look at this line here, which is the demand curve, and it is the demand, which is D, is equal to PMB. PMB is private marginal benefit, equaling to SMB, social marginal benefit. All right. So demand is equal to private marginal benefit, which is the same as the social marginal benefit. Now, at this point here, this is the free market equilibrium. All right, where the forces of demand and supply determine the price of the commodities to be sold at. That's why we see that at this point, Q1, which is the equilibrium quantity, all right, equilibrium quantity, and P1 is the equilibrium price. This is determined by the forces of demand and supply. But we are saying, hey, at this point here, we are saying that at this point here, there is no social efficiency, there is social inefficiency. All right, it is not good for the public. Remember this product in question is a negative externality. Okay, if you leave it to move at this point here, it is of course negatively affecting the society. All right, so what can the government do to come in and try to curb this kind of equilibrium? Because it is only benefiting the producer or the manufacturer for this instance. All right, so the government has to come in to try to regulate this kind of production so that supply is reduced, and in so doing the government has to come up with what we call the Pigou tax. And the Pigou tax for this case will force the supply curve to shift from this line here to the new line here. All right, it will shift upwards and create this second line. And on this new supply, now we are saying the social marginal cost, this point here, social marginal cost is equal to private marginal cost. All right, so now when you look at what happens, look at the quantity supplied. In this point here, we looked at this point, all right, where the social marginal cost is equal to private marginal cost. The Q2 is now supplied, which is the optimal quantity supplied. All right, please note that at this point the price is also shifting from P1, which was the equilibrium quantity, to P2. But also note that if it was taken at a point where the PM, the private marginal benefit, is the same as the social marginal cost, it would be here, and this would be P0, P0, price 0. All right, so because of the imposition of the tax, so it is shifting from P0 to P2. All right, so P2, this is because of the this difference here is what we call we term as the Pigouvian tax. All right, so note that now, because at quantity 1 the products were supplied and the society was at harm, was at risk. So that's why the Pigou tax was invented, was imposed on this kind of production, so that the quantity is now shifted from Q1 to Q2. All right. So, and at this point now the society, or the society is at least at optimal, trying to balance with the product and social benefit. The marginal cost, social marginal cost, is equal to private marginal cost at this point. All right, so basically this is what is about the Pigouvian tax. It is imposed by the government to try to curb the consumption of a harmful product in the society. All right, and its major purpose, the Pigou tax, major purpose of the Pigou tax is to make sure that supply is reduced of this particular kind of product. So that's why we see from Q1 to Q2 we are seeing a reduction of price, a reduction of quantity supplied, but a rise in the price of the products. So by exactly doing this, we are trying to minimize the amount of consumption of this particular product. Okay, I hope you try to understand this. Okay, so now this is an explanation. At point in a free market economy, the equilibrium will be at Q1, as I showed you already. Q1 here, Q1 is here, and we are saying that where D is equal to demand equals to supply, and the society is at inefficiency. That one I was already stated. So now the government has to impose this kind of tax, the Pigou tax, so that social marginal cost is equal to social marginal benefit. So that is basically why the the Pigouvian tax is in existence and how it works, right? So advantages of Pigou tax: number 1, fosters market efficiency. That is self-explanatory. Discourages harmful products or harmful activities, and so on and so forth. Just like smoking, if you ban cigarettes, you put high taxes on cigarettes, a few people will now resort to buying them. Now the other thing is generating additional income for the government. Okay, you tax these people, you get them money from them and use for other beneficial details. So now the other thing, how is Pigouvian tax different, disadvantageous, or how is it hard to do? So look at, it is very hard to measure the Pigouvian tax. You may hardly know how much it costs for the item, or you may hardly estimate clearly the cost of this harmful product to the society. So that makes it a bit difficult to understand. Then political issues. Pigouvian tax can be influenced by politics. If the government says, let this product go, let this product pass, however much it is affecting the society, you may end up using still this kind of product. So it may be harmful to the society. So that is a brief story, I wanted to give about Pigouvian tax. Thank you very much. Bye-bye. See you next time.